Green lights, the fundamentals are very strong. Just think back to December. What were the big fears in the market? It was that the global slowdown would take its toll and result in an impending recession, and that the Fed would be on its way to committing a costly policy mistake. Those fears have receded dramatically, today notwithstanding. So we'll come back to the tariffs in just a moment. But first quarter GDP growth was in excess of 3%. Jobs growth has been nothing short of remarkable. We added 263,000 jobs in April.
Corporate profits have been good.
Corporate profits have been good. So the fundamentals of the U.S. economy are stellar, and they don't signal any recession on the horizon. In fact, it is this very strength that has emboldened the U.S. party in its trade negotiations, because they want to leverage this renewed economic strength to extract greater concessions.
Jim Paulsen, same question for you. Do you see green lights ahead for U.S. stocks, reds or yellows?
Well, I agree a lot with what he said. I'm kind of a green light too right now. I would say this, Tyler, just to add on to what he's saying there. I look at valuation day, and the forward and trailing PE multiple is just slightly above average right now from where it was since 1990. And it is basically where it was at the end of the 2015-2016 slowdown and pullback in the stock market that occurred. And that was followed, of course, by the big rally in 17 into 18. So I think values are good. And I look at this. So far, the rally is because we paused overheat, the Fed paused, and inflation came off. And that's created a big rally valuation based. But I think the next catalyst here could be that we not only agree that we're not going to recess, that's kind of already come out, but we start to notice that earnings don't just do better than feared, but they actually start to reaccelerate. And growth turns out stronger than expected. And if you have rising earnings where the 10-year Treasury is still below 2.5% or 2.5%, and the Fed hasn't started tightening, inflation is still sub 2%, I think there's quite a bit of upside room for even both the multiple to go even higher, maybe to 20 times earnings, as well as 20 times trail, as well as earnings actually start to climb as well. So I do think there's upside yet.
So you're both green light kinds of guys, but Sandip, let's say tariffs actually go up to 25% from 10%. Let's say another round of tariffs go into effect on the rest of the goods that we bring in from China. Given the market reaction today, which is very, very muted to President Trump's threats, could you say that you would still be green light even if the tariffs were put in place?
Yeah, I think so. All this does, it pushes back the resolution. The end of this saga gets postponed a little bit, but it does not change the end game. And that is for one really simple reason. No one wins in a trade war. And to fully engage in one would be incredibly foolish. So yes, out of implementing the threat, we could have a couple weeks or maybe a month of these additional tariffs. Sooner or later, this will get resolved. Calmer heads will prevail. And in fact, the weakness today or anything that ensues in the following days might actually be a good buying opportunity.
Jim, this morning, Warren Buffett said he was most surprised that with full employment, a growing budget deficit, that the long bond was only at 3%. And that if it stays at 3%, stocks are ridiculously cheap. Do you think it stays at 3%?
You know, Kelly, I think I agree with that. I think with yield, the 10-year Treasury around 2.5 and trailing multiple at 19 and inflation sub 2, you could easily see multiples above 20 times earnings. They've been there a lot since 1990. They've certainly been there or better at different times in our history with any kind of remotely close environment like this. So as long as we stay in this area, I think there's upside room on values.
As long as we do, but I'm asking if you think we will.
That's right.
Yeah.
I think eventually, Kelly, yes. I think growth is going to be stronger than we think here in the second half. We might stay around 3% this year. And if we do, with the unemployment rate already below 4, we're going to see a return of overheat problems. Right. Wages maybe into 2020 head towards 4%, and we have to push 10-year yields back above 3, and the Fed gets back in the game. So while overheat's been paused, this is an opportunity. I think it's going to come back, and probably by 2020, we're going to be dealing with some of the same issues we had in 2018 again. Okay. But it could be from a lot higher levels than we are right now.